With 35 million people unemployed, with businesses shut down, with the markets tumbling, a lot of people are expecting another real estate market crash. But more importantly, they're trying to figure out when. When is the real estate market going to crash? Now, I've made a couple of videos talking about if it's going to crash, what we can expect. But today I am going to address when. So stay tuned. All right, welcome back. If you're new to the channel, my name is Mark Moss. I like to talk about making money, investing money, and having overall success. Those are my topics, and if you'd like to learn about any one of those, which I'm sure you do, click on the like button right now. It helps the algorithm, helps more people find these videos, which I really appreciate. And also click that subscribe notification, hit the bell notification so you're notified every time I put new videos on. Now today we are talking about real estate. Recently I've done about 3 different videos on real estate, hitting different parts. Now, a little bit about me. I've spent over 20 years in real estate. I've purchased, fixed, and flipped probably over 100, 150 properties. I've owned over 200 different rental properties. I've developed over $20 million in real estate. So I kind of know a couple things. I study it a lot. I pay a lot of attention to it. Now, like I said, I've done previous real estate videos just recently. I did 3. I made a case as to why I believe real estate was the best investment for the last 40 or 50 years, but it won't be. So I projected what's going to happen with real estate over the next 20 to 30 years. I made another video showing which part of the markets I expected to see softening first. But like most people, all the comments were coming wanting to know when. I said, okay, now you told us what to expect long term. Now you told us where to expect the softening, but when? Well, timing's impossible, all right? That's the problem. It's easy to see what's going to happen, but knowing when it's going to happen is the very, very hard part. If it was easy to pick when, we'd all be rich, right? But it's not. So I'm just going to tell you right now, timing is impossible to do, but I'm going to try. I'm going to try to take an educated guess looking at the information that we have. And I think I found a couple major facts here that are going to help us out. So let's see what you think. Now, I'm going to give you 3 factors. The first one that we need to take into consideration that's going to help us with the timing is understanding debt loads. Okay, we have massive debt loads. The U.S. households are cracking under the weight of debt that they're carrying. Okay, household debt has risen for 23 straight quarters. So basically, for 2 years, household debt has just gone up, right? As of April, it stands at over $14 trillion, $14.3 trillion as a matter of fact. And so according to the Federal Reserve Bank of New York, even auto debt is blowing up. Auto debt's been steadily rising now for 36 months. That's 3 years. And auto debt totals over $1.35 trillion. That's a staggering amount. $1.35 trillion for auto debt. We also have student loan, a massive bubble in student loan debt. That's at $1.42 trillion. Massive, $1.42 trillion. Now, so then we have credit card debt. And credit card debt's totaling more than $1 trillion, almost $1.1 trillion. Now, I want to say that to put this into perspective, in 2008, when the mortgage crisis hit and it took down the global banking, it was a $700 billion. So $700 billion in 2008 collapsed the entire banking system. One bubble of $700 billion. Today, that's 3 over $1 trillion. Auto debt, 1.35, student loan debt, 1.42, credit cards, almost 1.1 trillion. Now, in addition, that's not just the amount of debt, it's starting to go bad. It's starting to go really, really bad. As a matter of fact, we're seeing delinquencies, the amount of missed payments going up. In April, we're at almost 10% delinquencies, which is really high. As a matter of fact, it's the highest level that we've seen in over 2 years, and that's not good. The most frightening, though, out of all these bubbles is the mortgage debt bubble. If you think those $1 trillion bubbles sound bad, the mortgage debt bubble is $10 trillion. It's up $150 billion in just the last year alone. So it's growing super, super fast. It's climbed almost $30 billion in just the first quarter of this year, the first quarter of 2020. All right, so that's the first one. We have all this massive debt. It's already started to go delinquent. It's many, 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 many times higher than the bubble that happened in 2008. All right. Factor number 2, no income. Of course, right? As job losses increase, we see, job losses, layoffs, we see furloughs, and furloughs turn into permanent layoffs, etc. Well, the households are going to have a harder and harder time paying those bills. How are you going to pay for all those trillions of dollars of debt if you're not earning income, right? Especially the biggest monthly bill, which, of course, what's the biggest monthly bill? It's mortgage, it's rent. Right? Now, since the pandemic started, like I said in the intro, about 35 million Americans have filed for unemployment. Now, it's taken the unemployment rate from a historically low 3.5% in February to almost 15% today. That's an amazing gain from 3.5 to 15% per the Bureau of Labor Statistics, the BLS. They even admit themselves that this number is not real. They say it's way too low. Now, via survey the BLS conducts over a week, they did this one April 12th to April 18th. So basically, they're just looking at a week, so it's kind of like just like a snapshot. But they said that 70% of those surveyed households responded, which is less. Typically, they'd have about 83%. So the BLS commented that its own survey results, they were a little bit skeptical on the results. They didn't really think they were super accurate. And they said that the estimated 9 million people, they kind of pull a small group and then they kind of extrapolate the numbers. They say the estimated 9 million people answered that they were employed, but, quote, absent over the week. So it's unusual for that to happen. So in the survey commentary, the BLS said that the unusual number is about 7.5 million more than typical. So this indicates that those people should probably have been recorded as unemployed. Right? If they had been, then the U.S. unemployment rate would be not 15%, but almost 20%. So that's where they think it is. So it's somewhere between 15 to 20% is the real unemployment rate. Now, there's also something called the U6 measure of unemployment. And this includes workers who also say that they're discouraged, they're not looking for work. It's workers who are working part-time, who want to be full-time employed, but they're not. So unemployment doesn't even count those people. But just because you have a part-time job, you're not counted as unemployed, right? So the U6 gives us a little bit more of an accurate number. And if we look at the U6, it stands at almost 23%. All right. You're starting to get the picture here, 23%. Now, that number is also in question. A lot more jobs have been lost just in the last few weeks than we've seen created. I mean, even in the last decade. Like, we've lost more jobs in the last 2 months than we've seen created in an entire decade. Now, unemployment at 20% is double what it was during the bottom of the 2007-2009 Great Recession. So unemployment's already doubled what it was at the worst point, and I don't think we've gotten there yet. Now, as it approaches the 25%, we're going to surpass the record set in the Great Depression of 1933. All right? It's pretty bad. So we're on our way to meeting or exceeding that record. Now, we might get there. I think we could get there before people start getting rehired. I made the case before that the experts are saying that up to 42% of those job layoffs may never come back. Against this bleak employment backdrop, housing prices have held up nationally because there's little inventory for sale. All right, so this is like supply and demand. This is expected to change. I mean, basically, housing inventory, which is the number of homes that are available for sale, it's been low, and you have supply and demand. So if there's not a lot of houses to buy, but there's demand for those houses, it's going to keep those prices up. But as of February, inventory was down nearly 10% on a year-over-year basis. So that just shows the supply has been way down. It's down 10% from where it was a year ago. Now, during the last full week in March, the number for sale homes taken off of the market, so these are homes that were already for sale but pulled down, it jumped nearly 150%. That's a massive gain. So these houses were for sale and they pulled them off the market. But the jump in the homes being pulled off the market, to me, is the smoke. All right, what do I mean by that? Well, you heard the saying that where there's smoke, there's fire. Like, it's the canary in the coal mine, whatever you want to see. So for me, seeing those homes pulled off the market, that's the smoke. Where there's smoke, there's fire. And this fire, the big problems, is coming in the third and final piece. All right, so the third and the final factor that I want to look at that really kind of help me kind of hone in on when this is going to happen. Like I said, trying to find the timing, it's difficult, but I'm going to guess at it. And the third factor is what I call forbearance. All right, now the forbearance is basically like the forgiveness. And so what I mean is that, like I said, the home is the single biggest expense for most Americans. It accounts for most people, about 33% of their entire household budget. Now, per the BLS most recent consumer expenditure survey, they found the same thing. They said about 3/4 of all mortgages in the United States are federally guaranteed. So the government is guaranteeing those loans, 3/4, 75% of those loans. The rest, the 25%, the rest of those loans are private. Right? These are non-government loans. Now, Now, we've had the CARES Act, which is the stimulus bill. The CARES Act is basically granting relief or forbearance, as I call it, to homeowners whose mortgages are federally guaranteed. So if you're a homeowner and you're one of the 75% of those loans that are federally guaranteed, you have the option to take forbearance, meaning you don't have to make your payment, right? You can decide to, instead of making that payment, put it onto the back end. Now, these are all the federally guaranteed loans, 75% of them. So that's Fannie Mae, Freddie Mac, FHA, the VA, Ginnie Mae, etc. And under the CARES Act, borrowers with these federally backed loans are granted 180 days of forbearance. All right, that's 6 months. During that time, the payments aren't forgiven. The payments are postponed, right? Or at least they can be reduced, but the interest is still going to accumulate. Now, most times you don't have to pay anything at all. You don't have to give any kind of reason. You don't have to give any kind of a documentation. You don't have to prove any type of hardship, nothing. You can get a pass on making your payments. Now, after the 180 days, 6 months, then borrowers can apply for an extension of another 180 days. And in most cases, it can be automatically granted. So that means 6 months of no payments on your mortgage, and then another 6 months, so up to a year, that you can go without making a payment if you're one of those 75% of government loans. Now, the 25% of non-government loans, they're having problems because those people, the borrowers, they expect forbearance as well. If you're in one of those loans, then the borrower has to contact the mortgage servicer and request a repayment schedule. According to the Mortgage Bankers Association, as of April 30th, 7.5% of all active mortgagors, about $841 billion in unpaid principal, has already asked for and already gotten a forbearance. So about 7.5% of all mortgages are in forbearance right now. So think about that. 7.5% are in forbearance, meaning not making their payments. If forbearance wasn't an option, that would be 7.5% of mortgages not making their payments. That would mean 7.5% of mortgages defaulting. You understand what we're talking about here? So they're postponing it by 6 months and potentially a year. In addition to the 7.5% of active mortgages that are already in forbearance, mortgage services are saying that there's more than 500,000 new mortgages a week being added to that list. So already 7.5%, but there's 500,000 new people being added to that list of forbearance every single week. Now, as they expect that number to continue to increase every single week for at least the next probably 2 to 3 months, and as big as those numbers already seem to be, they could turn out to be just a drop in the bucket. Now, the St. Louis Federal Reserve Bank projects that 47 million Americans eventually will become unemployed, right? So we're at 35 million right now. They're saying up to 47 million. So if what they're saying is true, if we see that number, then the amount of forbearance agreements that we see right now is going to be a drop in the bucket. And then what about the renters? Well, renters around America are also saying, well, we want forbearance on our rent, right? And so what a lot of these local governments are putting these non-eviction orders where if renters don't pay the rent, the owners of the homes may not be able to get them out. Typically, if they have one of these government loans that they can get forbearance on. So if the homeowner, the mortgagor, is able to get forbearance, then the rentor also wants to get the forbearance, which I guess it makes sense. It's kind of justified for them not having to pay the rent, like I said, if the landlord's receiving forbearance. And this might be okay for borrowers, but what about the investors? So what about the borrowers not paying and the tenants not paying, but what about the investor that put the money up? They need the money, right? Those are going to REITs and those are going to pension funds. And what about that money? And so that's creating a really, really big problem. So after the Mortgage Bankers Association went and lobbied the government, basically the government decided they would pay it. Or basically, I guess you and I, we're the taxpayers. We're going to go ahead and pay it. We're going to backstop those mortgages. But this time around, it's going to be different. In my opinion, this time around, the damage is going to be worse. It's going to last longer, and it's going to hit the housing market, the mortgage-backed securities investments market, and the economy in a completely different way, in a much bigger way. I think way bigger, way more powerful than the 2008 financial crisis. So how, you ask? Well, it goes back to jobs, jobs, and jobs. You can delay people's payments, but if there's no jobs for them to start making their payments again, how is there ever going to be a recovery? So basically, we have these three factors all playing out into what I call the great unraveling, okay? So the problem starts to surface when the forbearance runs out. So this is where we get to the time where I'm starting to try to put a prediction on the time. When will we see the markets crash? Well, I believe the problem starts to surface when the forbearance runs out. So it's 6 months. and then potentially extended another 6 months. So I think after the forbearance runs out in 6 months, we could see a massive amount of homes start to flood the market. Remember, we talked about the homes being pulled off the market. So all those people were trying to sell their homes, but when they were told they didn't have to sell for 6 months, they pulled them off the market. Well, as soon as that forbearance runs out, all those homes go back on the market. It floods the market, especially in the hardest hit areas. And then supply and demand, when we have too much supply, not enough demand, it's going to depress the prices, all right? And it's going to push the prices down. So I think that we're going to see this first batch in about 6 months from now, and then we'll see another batch in 6 months after that, depending on how many get rolled over. Now, the central bank's decision to buy a nearly unlimited supply of government-backed mortgages, has helped calm the market so far, but the market for loans in which the government doesn't provide risk, the non-government loans, well, those investors, they're abandoning the market altogether. And so those types of loans are already starting to dry up. They're starting to disappear. When home values and their underlying mortgage-backed securities, both government guaranteed and private, when they start to falter and fall, the same negative feedback loop that tore up homeowners and mortgage-backed security investors, banks, finance companies, investment houses back in the 2008 financial crash, I believe it's going to revisit the economy and further slow down the country's recovery. I think we're going to see, given the job losses that we've seen, again, 42% of which may never come back because of this new normal that, we might not ever see many of these businesses ever be able to operate under these new conditions. And that's only going to exaggerate and make things worse. But not to worry, I'm not trying to paint a doom and gloom picture here. Just like in 2008, there's always going to be ways to make money. I learned a strategy back then that there's no such thing as good and bad timing, only good and bad strategies. So there's going to be lots of ways to make money as this starts to unfold. But the first thing that we need to do as investors is we have to focus on capital protection, capital preservation. Once we can protect our capital, then we can focus on putting it to work in capital growth. So that's kind of the strategy. Does that make sense? So that's it. That's my best guess as to timing. Everybody wanted to know, when is it going to happen? I think the first wave in 6 months, second wave in 12 months, based off of those forbearance agreements, assuming that the economy does not have some radical V-shaped magical recovery, which I think is doubtful at this point. Let me know what you think down in the comments below. Do you agree with the 6 months and 12 months, or do you think we're going to have a recovery and it's not going to crash? I'd love to hear your perspective. Give me a thumbs up on it if you like it, and if you don't like it, give me a thumbs down either way. Let me know in the comments. That's all I got for you. To your success. I'm out.